So I think that there's opportunities to buy dips in very high quality areas of the markets. The place where we certainly do not want to be buying dips is in the speculative, high valuation, more innovative types of the market. That's the areas where, yes, we've seen a lot of weakness. And yes, these areas could stage some really big bounces off of oversold levels. You saw the degree of bounces that you saw in areas like Snap and Amazon today. But the liquidity environment for those speculative parts of the market is going to continue to be a headwind, and it's going to get worse from here. So if we see bounces, we're really inclined to want to sell those rallies and reduce positions, and then focus more on the high quality parts of the market in order to buy into the dips.
Chris, we've almost gotten used to this correlation between higher yields and lower NASDAQ. Today, that bond seems to have been broken. I guess it's an inverse correlation when you think about it. But do you think we should be able to kind of expect that same correlation moving forward, or are things different now?
No, I think the correlations still are in place. We are moving into, higher rates on the short end. But also, what is the Fed going to do as it exits its positions and begins to roll off its balance sheet, and how that impacts the long end? I think your other guess is exactly right. What you want to try to avoid here is these really high multiple stocks, and look for companies that can have good earnings, good cash flow, good balance sheets here. The market this week and last week has been digesting a tremendous amount of information, both from companies and economic data. And I think, as bottoms are put in, and I'm not calling a bottom yet, they can take a while. So the market needs to digest all this information. And I think you just need to look for those good companies that look long term.